Hello, everyone. My name is Dominique, and I have the rest of the Greenleaf team here with us today. And today we'll be doing a residential market update, as well as our 3Q 2021 live stream review for our multifamily portfolio. But first and foremost, want to share our mission for Greenleaf Connect. Our mission really has always been to be informative and transparent for all of our audience members associated with Greenleaf. Live streams are open to the public, while private Connect events are closed and really more interactive. Live streams are dedicated towards our new deal launches, quarterly updates like this one, market trends, and anything in between. So today, folks, we will be discussing a market overview. Specifically, we'll dive into the apartment segment, mobile home segment, and then we'll discuss future residential plans, and then we'll end with that Q&A session. This is a friendly reminder that to use the Q&A feature located at the bottom of your screen under the reactions button. Feel free to submit any questions you have throughout the duration of the presentation. You do not need to wait till the end, and we'll be sure to filter through those towards that ending segment. Also, we want to remind you that this live stream is recorded and will be shared with you by the end of the week this week. And feel free to change your presentation view to speaker spotlight view, or you can click and drag to make the presentation bigger or smaller. All right, folks, I'm going to pass this over to our hosts, Dave and Josh. Thanks, everyone.
All right, thank you very much, Dominique. Welcome, everyone. We're excited to talk about this third quarter. We had a great residential quarter overall. We got a couple points we're going to cover today, from just recapping on what we've been talking about for 2021. We're also starting to see some of the short-term impacts that are showing up. We're going to dive into all of the portfolio performance and then talk a little bit about future stuff. So last quarter and even in the first quarter, we've been talking about the delinquency. Really, that was the biggest part that, COVID 2022, we're like, okay, what's the picture on delinquency going to look like? We looked at this last quarter. We had 14% of renters that were behind nationally, so it's about 10 million people. And then we had about 3.5% of home loans that were in forbearance. This is all coming from the Mortgage Bankers Association. They publish the data almost weekly on what stuff looks like. And then we've been discussing the eviction moratorium.
On a regular basis, and just the latest of what's going on with it. As you guys remember, it was supposed to expire over the summer. It didn't. They extended it, and then it finally expired. What, September 30th?
No, August 28th. End of August.
End of August, and then so the federal part got lifted, and now we're still managing through the local, state, and
it actually got more confusing.
Yeah, it was very simple, very straightforward. Now
there was one policy. Now there's one for every place that there's a building. So so a little more complicated. But so we're gonna take a look quick on what the charts look like for 2021. So we think about this like delinquency, and there's not a lot of renter delinquency information, but there is on the home loans. So when we think about even home loans, like how does that impact the rental market? It really happens from the supply constraints. So we wanted to show this just to show, what things look like comparatively. We all remember, for the most part, 2008-9 as that mortgage crisis happened. And you can see this chart goes back to 2005, and it's showing the spike that occurred and then how long it took to kind of wind down, right? It was really like 2011, 12, we felt like kind of coming out of that. It was making some good progress down, but it took until, you're looking at this chart, almost until 2017 to get back to our normal average. So it's 10 years.
Right.
Maybe it's not 10 years. What is that? 8 years.
8 years, yeah.
8 years. So, and now you see 2020, this chart jumped up and it shows, okay, the numbers are back to where they were 2008. And that's where this chart comes in. This is talking about now forbearance. So different than delinquency. This is like they're actually in a forbearance. I am not going to pay program. Yeah. So here it's normally historically fairly low. Like these numbers on the left-hand side there are 0.09%. The yellow line is the total. So it's 0.09% historically. And then now it's at 2.21%. What's the math on that one?
What, 2.5x?
Or 20. It's a lot higher.
Oh, 0.09.
0.09.
Yeah, sorry.
2.21.
Yes.
We didn't pre-do that math loaded in there. So yeah. But it's still very high, and it jumped right away coming out of COVID. So now it's like, it's just still very high. We have a long ways to go. And according to the past, it's gonna take a little bit of time for it to come all the way back down. So what's that's basically doing is in forbearance, it's limiting the supply. So there's not as much supply. And then now we have this idea of we're going to start removing the artificial supply constraints. The first one that was removed was eviction moratorium. So now no longer, we talked about this slide last quarter, no longer is the stay and don't pay option really there in the apartment space, at least. It is in the mortgage part, but not in the apartment space.
Yeah, and then talking about supply constraints, that's really been driving up home values, driving up rental values, but why people staying and not paying. And that's basically what we've been realizing in the housing market and the rental market.
So now we're going to go through like, how is this impacting the apartment business? How is it impacting the mobile home business? So the main thing we're kicking off with is delinquency. We've talked about this consistently for almost 2 years now. It's been a while. And what we have here is we have what our Q1 2020 delinquency was, right? So we had 48 people that were in this gray and red, which are like over $2,500. We fast forward to the second quarter, and now we start seeing people that are $10,000 over. They're still not paying, and that number's growing. And then jump to third quarter, and we're finally starting to see a decline. So,
and just for reference, our average rental unit is $900 a month or so. So $2,500 is basically someone that's behind multiple months. It's once we see someone behind multiple months, we don't normally see them catch up or pay out. When they're behind 1 month or less, we normally see some kind of catch up, some kind of payment plan, some kind of payout, some kind of program that can sometimes help them. But once it exceeds that kind of $1,000 threshold, we normally don't see recovery.
especially 10,000.
Right, especially $10,000.
I guess
It's happened.
I guess the over $10,000 is kind of new territory. That's not, we never had that in the past before. So now we have the positive news though, is our total delinquency went down for the first quarter since 2020. Since the first quarter of 2020, it's been going up steadily as we've had non-payments. So now we're finally seeing a drop in the third quarter. Granted, it was only $20,000. It's still,
yeah, it moved.
it's like the needle's moving in the right
Yes.
direction. It's not going up anymore. So here we have, it's still $340,000 is a lot of money. We had 8 assets that increased delinquency, but we had 10 that declined. So you see the properties up here, like these are all assets that got better on the delinquency front, which is exciting. We had more that improved than they got worse on delinquency.
And we also got to remember our properties in the OZ, kind of the far right hand part of this table here. These are in very heavy transitional areas where they're very much a kind of a mixed tenant base, and they're coming from a very distressed area that are modernizing very quickly. And so it's somewhat expected that we would see this hit harder in the OZ parts of the market than in the non-OZ parts of the market.
Yeah. All right, so the next part, if we think about, that's apartments, and we look at mobile home part. Mobile homes are interesting in that our delinquency, it actually started to improve last quarter. So we saw our first improvements last quarter. When we look at Q1 of 2020, right, we still had 11 people that were in this over 5,000. We got, 48 people that are overall late. And now we jump forwards Q2, down to like 10, 12 people. And then to now, in the third quarter, we have 7 people, and we have 1 very delinquent person. So we're performing a lot better on the mobile home side, like it's getting better, but still like 10 residents that owe $35,000. That's like painful. Yeah, the top non-payers are pretty substantial, just like they were in apartments. They don't, our average rent is half of an apartment. So they're not paying for
for $35,000.
10 months.
Yeah.
It's like they don't really have much intention to pay after that at this point. So all right, so if we think about like overall trends in delinquency, so like what we call them super non-payers, right? So super delinquents are declining. our average delinquencies are also declining. And then we have the compound where like, we don't really see, just like we saw that chart in the mortgage forbearances, and it took years to get back to normal. We think rents will get back to normal faster than the mortgage part, but we're still middle of 2022 at least, right, before we see any kind of normalization of a delinquency rate.
Right, that's going to depend on kind of each municipality based on.
Yeah, we still have lots of places that have eviction moratoriums on a city by city or county basis.
Right, I mean, but a third, maybe even more than that, 40% of our multifamily portfolios in the city of Atlanta limits, which is still under eviction moratorium. So we'll see how that plays out.
Yeah, when we were guessing middle of 2022, that assumes everything economically still performs well and that those moratoriums are lifted. If any of that changes, though, we're probably, if any of that changes, we're going to be wrong on our guess here to start with.
Right.
So, all right, so we're going to look at occupancy, and this is really where, you know, we mentioned that we're starting to see some short-term impacts come to life now in the third quarter. We've had steadily growing occupancy for multiple quarters.
It seems like forever.
But also aided by the fact that some people didn't have to leave. We didn't have that normal attrition that we would for non-payment. So we ourselves were artificially held back because of the supply constraint, and now we're starting to see some tenants that are moving out.
Right. And overall, as a goal, we aim for 95% occupancy and 70% retention. And as our occupancy goes too high, our retention goes too high, we start increasing our rental rates to really soften that back down to make sure that we're realizing the market gains in the rental rates. So as we see kind of occupancy flatten out here, as we see retention rise, we'll start, we'll start flattening our rental increases month over month.
Yeah. We have, all of our assets. This blue line here shows 90%. So we're over 90% on all of our assets. We got a couple assets in here that had pretty large gains. 1209 Memorial and West Side that, they bumping up into the high 90s, which is excellent. Fairway was the one where we had an occupancy decline. But here also is we had a large portion of our delinquent tenants here. So they actually vacated. So this drop is positive in that standpoint. And we only had an occupancy drop of 0.2%. But that is still, every other quarter we've had 2-3% gains.
And part of that churn of, you have someone not paying, we're able to remove them and then put in someone that is paying. We're also able to realize the market rental rate. And so we saw, overall revenue was up 1%. A lot of that was the churn of units and getting new residents, and then they're paying higher rates than say a year ago. We might have leased a unit for $850, but this year we're leasing the same unit for $925.
Yeah. So our rental rates are up about 4 to 6% this quarter across deals, and that's one quarter over. This quarter over last quarter, not over a year. So that's pretty substantial if you think about that on an annualized basis. And our revenue up 1% this quarter, again across all of the deals, is just a quarter. So that's annualized 4%, but that's probably lower than we've had. Not probably, it is lower than we've had the past 3 quarters. The past 3 quarters have had higher revenue bumps. We've also had occupancy jumps as well. So kind of tied together. And again, Josh mentioned our retention. This is the first quarter that we had over 60% retention. So one, we had not a lot of people leave if they were non-paying and staying, but then also not having great retention. We're there now though. We're not there. We're getting back to having good retention and falling more in line with the market metrics that we want to be seeing.
Right, and talking about kind of occupancy retention, we kind of balance those two things out. Occupancy is really our kind of driving our income side of the P&L, when retention is really driving the expense side of the P&L. If our retention is too low, that means we're turning more units, spending more money on churn. So we want to basically soften our renewal rates to get people to stay, so we don't have to spend all that money on turnover. And the same thing with occupancy, that if we don't have enough occupancy, we don't have enough income. So that was pretty straightforward.
Yes. And that's why we're always talking about those two metrics. So when we think about mobile homes, here we're continuing to see occupancy gains. Now we did sell some of the middle performing or poor performing mobile homes. So now we're left with really assets that are performing very well.
Yeah, we kept our North Georgia properties, which have historically performed very well, and they continue to perform very well.
So we also have Creekside that is on the
Oh yeah, that should be selling today.
Yeah.
So any investors in Creekside, that should be done today.
But overall here too, occupancy, revenue from the occupancy gain is up 7.5%. This is simply 7.5% this quarter higher than last quarter. So financially, with the deals that we have here, we had an excellent quarter.
Yes.
We're going to look at, what does that mean? How do these two compare when we think about the margins on the apartment business and the mobile home business? We kind of compare the two together. First one being apartments.
Mhm.
So the main driver here, we look at this as 39% of our costs are non-controllable, which we think about taxes, insurance, interest, and principal. And we can't control those costs. That's 40% of our cost structure.
Right.
And then another 35% are manpower and repairs. So the biggest chunk of what we have is more or less a fixed cost that isn't really changing month over month. Whereas we can control wages and salaries and sort of repairs, but that portion is still less than non-controllable. So net here, though, apartments, again, Josh and I, we're always looking at cash flow. Cash flow investors in our portfolio is netted about 12% in this quarter. If we include principal payment, that's 17% on income. Compared to the mobile home side, though, mobile homes, you see the numbers shift a little bit all over the place. It's like all wonky when you look at it. Our utilities are drastically more expensive.
Yeah, we had this hybrid model of we own the homes or the resident own the homes, so that would make sense that maybe the repairs is less impactful because the residents are maintaining their homes.
None of our residents own our apartment.
Right, exactly.
Yeah, we don't have that yet.
Right, and then the combination that by removing some of that, removing that margin out of repairs, it goes in other places like utilities. We do pay the utilities on all of the local networks. That's why you see a bigger shift over there.
Yeah, and then overall, our net margin here is about 23% on revenue. So they're performing very well. And this is higher, it was 19% in the third quarter of 2020. It was 18% last quarter of 2021. So very good numbers here on the margins in the mobile home business. So we're excited about that.
I think this is a really good example of, we've now owned all these mobile homes that we're talking about now. We've owned them for over 3 years. And like Dave just explained, our margins just keep getting better and better. This is a big reason why Dave and I are such big proponents of holding our properties, refinancing them, and just continue to hold them because number one, a property we know and own is so much less risky than a property we don't own. Yeah. And we know it's so much better. And then we can also drive the margin so much more when we know the property, we can manipulate it in the ways that we can. And our operations team knows it so well. They know where to put the resources and manpower to improve our margins.
So the biggest part too is cash. So we're always looking at like how much cash we have that we can make distributions with. And about a year ago, we really went into our reserve strategy. We did a bunch on making sure that it was consistent and provided us with enough flexibility to execute in the business. So got this 3 month of operating expenses, annual taxes, annual insurance, and $300 a unit. Now that's a different number on every property. They all have different operating costs. They all have different number of units. But that number is basically the core reserve that we need on asset by asset basis. So here we've got a couple of things where we have deals that are yellow, meaning they do not have sufficient reserves, and they have to earn them up. And predominantly, you look at those are recent lease up deals. We have all of our QOZ deals on the right that are just coming into this like stability and operating and building their cash. Whereas QOZ1, you can see it's at 77%. And that deal, we refinanced it. So we were able to put it in a position to have it a good chunk of its reserves.
Right, and part of when we raise money for a new deal or we refinance it, basically part of that capitalization, whether it's on the front end or on the initial financing, we build that capital stack so it has the reserves. And really the risk of operating that deal and impacting the reserves usually come from unexpected capital items like a big plumbing issue underground or a roof leak or something that's that's really, we did our inspection. It said the roof has 7 years left on it, and something happened and it went awry. So that's where you kind of see some dips or some inconsistencies over time, and we'll on a deal by deal basis we'll report those out to you.
Now, the ones that are all green, so if you look across most of this on the apartments, they're all fully green. And these are all the deals that are then paying out. So once we meet our reserve requirement, all the remaining available cash is distributed out. So when you get your statements that are coming out early next week, you got our quarterly newsletter yesterday. And then with this, you can get an idea of these are all the deals that are paying out that are fully green. Deals that are not paying out, there's certain things going on with those deals. So for example, Hillcrest, that first one, number L017, we are lining up the sale of that asset. We've spent money on getting that in place. So it's not making a distribution as we prepare for that. L021, we've done a bunch of capital improvement work at, so therefore we spent some of our reserves. And the remainder of these deals are either very, very close. If you look at L044, City View, that one, it's like right at the amount for the reserves. And at City View, we have a almost $300,000 debt reserve that we had to put in when we refinanced the deal, and that expires in November 17th. So once we get those funds back, that'll actually count as money that we have that we can then distribute. So we're working on that part.
And one of my favorite parts of our cover sheet, as you guys look at that, they'll come out next week and you look at them. There's a section that talks about our cash balances and reserves, and really the contribution to reserves. And the last line, it's kind of in the top center of the sheet. It talks about quarters until we meet the reserve. And a lot of these properties are within a quarter of meeting the reserves, like a Kingstown, like a
even like City View is like
even City View, exactly. Yeah. So and the ones that are a little bit longer, they'll tell you how much longer and what to expect.
All right, so revenue wise, though, we're up 4%. We're up 1% in revenue for the apartment side. If we look at the mobile homes, we have the same, similar situation. So we have a couple deals that are fully funded. They have all the reserves and they're in great shape. Russell Village here, this one has the best loan out of all of them because we got it with Fannie. We were able to do that there. The other
3.6%.
Yeah, which is phenomenal.
We closed the week that COVID shut down Fannie Mae. So I'll never forget that one. Last year.
But the other ones are all community bank debt.
Yeah.
So it's a shorter term loan with those. So we're going to run into situations where we're doing kind of what we call our buy and hold, buy versus hold strategy, and really looking at the best sources and uses of capital at that time. With those loans, as they're 3-year loans, so that happens more often there. With Russell Village, we got a 10-year loan, so it's in great shape again at 3.6%. We look at deals like Barnes that don't have any of the reserves right now. All the other ones that are there, Point South, L026, which is 4 Gainesville deals, Russell Village, they're all making their distributions. Creekside that we're preparing to sell, so is not going to send anything out. And then Barnes, this one is a smaller deal. We don't have any debt there, but when we look at our delinquencies, this is one that got hit pretty hard from non-payments. So, and then Baker and Glover, this one, you see we're at 9%, but we did a bunch of electrical improvements there this past quarter. So we spent our reserve money. We were holding it so we could spend it on improvements, and we did a bunch of meter pack replacements there, which is like the kind of the pole, not in the ground, above the ground, that then you connect the power to the mobile home. We have to replace a bunch of those as they age out, and we were able to do that there. You see overall revenues up 7.5%, so that was very good. Expenses were up as well, though, but less than revenue. And the main thing was our overall CapEx down a lot. Net CapEx was 90% of that was at Baker and Glover for the electrical repairs. So our free cash flow is drastically up in Q3 versus Q2 as a portfolio. All right, so where do we go next from here? Right. So we've got these sales versus hold discussions that come up, and every time we do one of these, we're trying to make sure we share all of that kind of process and insight into what we're looking at on every deal. right? Like we want to be as transparent as we can and see how do we get to our decisions long-term in the business.
Yeah, we look at every property really every year and value it. And like, I think Hillcrest is a good example because we valued it in January and the value came back at roughly 65,000 a unit. Our basis is 35,000. So it's still tremendous gain. Would have been excited to have that great victory. But at 65,000 a unit in today's market, we looked at it saying we would buy that from ourselves. Why, with the gains that, it's constantly has 5-6% annual rental growth. It's performing well. Inconsistently making distributions, but at that price we buy it from ourselves.
It was making about 4% annual distributions in that deal.
And so what happened was, fast forward 4 or 5 months later, and someone came knocking on our door at $100,000 a unit. And we're like, there's no way that the market doesn't justify that. No broker in the world.
The new market does now.
Yeah, it would justify that. These guys evaluated it over about 60 days. They basically stayed firm on their price, and we thought it was almost too good to be true, so we went with it. And they're closing middle of November.
Yeah.
So earnest money is hard and seems to be going. So that's kind of our approach, is really to do that value, make that decision. But if someone comes knocking on your door at an unbelievable price, everything's just about for sale. So
we think on the acquisition side, we're really looking for a needle in a haystack on this one. We haven't found any residential deals that we can really get our heads around from a numbers wise of buying something that's at a cap rate, I don't know, in the 2 or 3% range or something. I need that, like, it's kind of crazy, and it still is, and prices are going up even more now.
Yeah, basically the guys that are we evaluate other people that are buying multifamily deals and look at their decks to see what we can learn. And if you look at what the guys that are buying multifamily, how are they doing it? They're basically saying that the last 5 years have had 5 to 7% annual rental growth. So the next 5 years will also have 5 to 7% annual rental growth. And that's how they're making the numbers work. And whether they're right or wrong, it's just not something that we necessarily believe in, kind of that trend line following indefinitely. So we've struggled to find assets that work for us.
Yeah. And then the last part is just refinances. So we did the Park Hill refinance. It was a huge success. That's an asset where we have a great basis. We are seeing great rental gains on our rates there, and it's a very stably operated deal. So we're excited about that. We have Rosecroft that's coming up here first thing in November, and then Westside Townhomes that is on the block too for refinance. So these are deals where we're able to get permanent financing. I think Park Hill was 3.49%. It's pretty darn good.
Yeah, it's close enough.
So we're all it's like this mid to low threes is where we're getting the long-term debt, and this is Park Hill was with Fannie, and the other two will be with Freddie SBL, which is under $7 million.
Yep.
Under $7 million of total debt size goes to the Freddie program.
Yes.
So those are the ones that are in the immediate queue. And then after that, a large portion of all of our deals are locked with long-term debt at very attractive rates.
Right. We do an annual review of really where our interest rates are and how much time is left on the debt, and does it make sense to refi something early or whatnot. So we do that basically during our annual budget process and kind of plan out the refis for the upcoming year. So if there are any changes or plans to refinance any of our apartments or mobile homes, we'll report that out with our year-end quarterly reports and budgeting process.
Yeah. All right. So opportunities on the 2021 side. If you're on our commercial presentation, we went through some of these as well. We're getting we got a lot of Applebee's coming in there, and we like the dollar store platforms. Our big two ones, though, this Covington Flex, that is our first real true industrial flex deal. We've talked about that some. We talked about that a lot in the commercial presentation too, of what that looks like. And then same thing with the Midtown complex, which we spoke about. It's very large, almost 300,000 square feet, and it's got lots of government medical tenants that are in there. So it's on the commercial side, it has the tenants that we like to see that enable us to get the best debt that's out there. So
right, I'm sure you guys talked about on the industrial side of the commercial presentation, but part of what we like about the industrial flex opportunity is that these buildings are designed to have multi-tenants. And there's such high demand. Most of the markets for the industrial flex are over 96% occupied, with annual rental rates growing by over 10%. Because this is kind of a shadow market to the Amazon, the new Amazon just-in-time delivery service. And so the rents are not high enough to justify building. So what's in place is has been growing tremendously. So we're excited about these properties because it reminds us of the multifamily days where basically you can turn units and get much higher rental rates and realize market value so easily. So yeah, we're excited about getting into that field.
We don't have any residential stuff in the queue right now. Eagerly looking. Haven't found anything that fits though. But if we do, we would definitely be excited to make it happen.
Yes.
All right, we're going to turn over to Dominique, who's going to touch base on a schedule some, and then jump into the Q&A.
Yes, thank you, Josh and Dave. Before we dive into that Q&A, we do want to remind you of our end of quarter schedule. Yesterday, the quarterly newsletter was shared with you via email. Feel free, tongue-tied today. Feel free to check that out with all of our upcoming updates, as well as communications in regards to our employee goals and whatnot. We love to get that quarterly newsletter out to you and get you plugged into the business and let you know what we've got going on over here as well. This is a friendly reminder, by October 29th, your 3Q commercial and multifamily recordings will become available to you via email. And on November 2nd or early next week, your property investment overviews, as well as any applicable disbursements, will be available to you. All right, I will kick it over to Natalie to begin our Q&A discussion.
Great. Thank you, Dominique. And thank you to everyone who submitted questions. We want to remind you that you can continue to use the Q&A feature at the bottom of your screen to submit questions as we work through those that have come in so far. So we'll dive in. First question, you reviewed this earlier in the presentation, but can you remind us of how many actual non-paying residents we are carrying, and are these people mainly at a specific property or area?
So right now we have 40 that are over $2,500 or like the very delinquent tenants, and they make up like 80% of the delinquent dollars we have. And I think it's substantial even when you go into the top 20 for both mobile homes and apartments. So, but a focus on properties, our most delinquent tenants right now, or residents, are really in the opportunity zone properties. That's where we've had the most delinquency. As Josh was talking about improving areas, that's where that's at. But overall, it's been pretty much like, hey, one or two people across all the properties. So there's not like a huge, like, oh, hey, of 40 people, 30 of them are at one asset. It's not, it's ones and twos across everything.
What challenges do you foresee as a result of the local moratorium still being in effect with no clear end date, especially in the city of Atlanta?
We see lots of challenges with that one. Yeah, it's just hard to manage a local, like, one-off.
The influence we have and the control of it is so localized. It's pretty tricky. One thing we've talked about is that we are still able. People are still leaving. There's only so long you can stay there in kind of that situation. Usually it's someone in a distressed situation and they're trying to make themselves better. We have to believe in the human decency of the situation. So there's only so long that they're staying around. So as people are leaving on their own, we are having some people that the ones that are less decent human beings, they usually break something in their lease as well, and we're able to evict them for that violation in their lease. So there's lots of ways to kind of manage around it, but until it's fully lifted, we're going to have to navigate our way through it.
Yeah, and everyone is different.
Can you provide an update on our eligibility for federal grants or relief programs? One being the Paycheck Protection Programs that we applied for in 2020, and two, the federal rental assistance.
Yeah, all the federal rental assistance, it's interesting because it's really for people that have employment loss or loss of income or stuff. So if you're fully employed but not paying your rent, there's no programs out there for that. That's not one of the gigs. But some states, when the federal government did it, they awarded states buckets of money to then provide for rental assistance. And specifically like North Carolina, that state has done a very good job with the application process. And we're doing that hand in hand with residents to apply for those funds. But each state, again, is different on how they're doing it. And right now, North Carolina, for us, has been the easiest process to do that with.
Are there any other properties you're considering selling in the coming months?
Coming months? No. We were looking at Beaver Creek and Point South to address those. We basically marketed those over the summer, chose a buyer, went through some contract negotiations. Ultimately, it didn't work out with that buyer. And so we basically decided that now is really not the best time of the year to really market a new property for sale. So we're basically going to put in selling anything on hold. But Beaver Creek and Point South are really under evaluation, whether we want to look at that for selling next year or look at basically a hold because they are performing very well.
And we do with those, anytime we have a loan that's expiring, we have to go like, hey, we're going to go through the refinance process or we're going to exit the deal. Because no matter what, we can't just hold.
Can't do nothing.
Or else the loan expires. Like we don't have mortgage loans that just go till the end. You want to hold it, you can pay it off. We have to refinance or do some kind of capital transaction. So every time we're doing that and getting prepared to spend lots of money, we're assessing what the best use of the capital is.
And what about the Paycheck Protection Program?
So that was in the very beginning of COVID that we applied for that, and there's not anything really new with that program.
Yeah, we received our, Greenleaf submitted its paperwork. We received the funds. We passed through basically the payroll part of it to the properties. And
it was unforgivable.
But that was what?
That was
through
the end of like July of 2020 that we use those funds.
Right.
With the moratorium on evictions opening up supply, will rental rates come back down or will the rates stick?
Our assumption is that the aggressive growth in rental rates that we've seen will slow down as more units come online. So we think they're going to drop. There's still going to be positive growth, but it's not going to be, hey, we had 10%, market rate increases quarter over quarter. Like that's, I don't know, so that's not sustainable. We don't see it continuing at such a high clip on quarterly increments.
Or to our last submitted question, could you give us a recap on how Greenleaf is prepared for what's next in residential space?
Yeah, right now it's really just maintaining our reserves and making sure that strategy puts us in position to handle anything that comes up, so we are able to hold long-term and continue to produce cash flow.
Yeah, and going back to the previous question about rental rates and the supply constraints is we do expect that these delinquent tenants will be leaving. We will need money to turn their units and release their units at higher rates, which will drive income, but we'll need that money to turn the units. So that's why we're so heavily focused on basically beefing up our reserves and getting them in a position so that we can afford that turnover and realize increased rental rates.
Yeah.
Great. Well, we will stay online here for a few more minutes in case anyone has additional questions, but we want to thank everyone for all of your great questions. And of course, we want to thank Dave and Josh for sharing these residential updates with us. As we wrap this up, just a friendly reminder that quarterly reports and distributions will be sent early next week. Now we'll turn it back over to Dominique to review our upcoming dates.
Yes, thank you all. This completes our end of quarter reviews for commercial and our multifamily portfolio. On the 11th, we do have a new deal overview for Covington Flex scheduled, and live stream registration details will be sent to you as soon as those become available. This is a friendly reminder to join us for our Greenleaf Investor Forum rapidly approaching us. All are welcome to attend. And if you are local and think that you can just join us for our evening reception or welcome dinner registration. Within the registration link, you can select specific activities that you are able to attend. Well, thank you so much for joining us today. Don't forget to check out our Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available to you by the end of the week this week. This concludes our broadcast. We certainly thank you for joining us today, and we hope to see you on our upcoming live streams, hopefully tomorrow. All right. Everybody have a great day, and we'll see you soon.
All right. Thanks, everyone. Have a good rest of the day.